We go on.
So happy Thursday, everyone. It's Greg Dixon here with Jet Visions Unlimited with Betty Withrow. And our guest today is Paul Levine. And Betty and I have helped or working on getting Paul's book launched, The Bible of Real Estate. And we're going to talk about a topic that's really the first chapter in the book called Why Invest in Commercial Real Estate. And Paul, why don't you introduce yourself a little bit and we'll get started here.
Thank you, Greg. My name is Paul Levine. I am a commercial realtor, but I am unique. I was a practicing certified public accountant for over 50 years before getting into real estate. I had 10 no change IRS audits in a row. I negotiated the sale of one of my clients to this small company in Delaware, actually one of the largest publicly held companies there is in the name of DuPont. And I was also an expert witness and did a lot of other things that other CPAs just never do. And I am someone who has 50 plus years of income tax experience. And I have more, as I like to say it, education, knowledge, experience, creativity, and expertise than anybody else doing what I do. And today I'd like to talk to you about why do you invest in commercial real estate? And as it turns out, this morning I opened up my email and somebody wrote down the 12 reasons why you invest in commercial real estate. And I don't agree with everything he said, but I will give you his titles and I will tell you what I think about them. The first thing was to generate wealth, not income, but wealth. And you generate wealth when you have an income producing property. When you have an apartment building, for example, that's there forever and it's going to generate income year after year after year, it also gives you increases in wealth every year. And that wealth comes about by the neighborhood maturing, by the increase in rents, and by different things that are done to the buildings. And I grew up in an area called Flushing, Queens. And we lived in what was known as a co op. In Los Angeles, we don't have co ops, we have other things. But in New York, they had co ops where you own shares of stock in a corporation that owned the facility or the building. And those buildings are still as good today as they were in 1956 when we moved in there. My parents moved there. I had no say in it. But that's the type of asset we're talking about. The second thing was to have reliable long term investment. And like I just said, that investment is going to be there as long as you want it and as long as it's doing what you want it to do for you. Neighborhoods change. The amount of money that you can take out of the asset may change due to the change in the neighborhoods. The third thing was protection from inflation, and that's just obvious that as prices go up, so do rents. And therefore, you know you have enough money coming in from that asset. There are different forms of real estate that you can invest in: multifamily housing, commercial properties, land, office building, short term rentals, long term rentals, all sorts of different investments that will give you different types of returns on your investment. For example, a short term rental is going to give you fast money now. Um, a self-storage facility will give you more cash flow now than an apartment building will. And it depends on what your, and this is an expression that I love, your needs, wants, and desires are. So, excuse me for 1 second. Actually, I should be making money today because this is what I'm drinking. Anyway, um, so your needs, wants, and desires change as you grow, as your family grows, and as the economy changes. And the economy is on a never-ending roller coaster. It goes up and down and up and down. And you are seeing, excuse me, you are seeing that every single day in the changes in real estate income, not income, interest rates, because the interest rates go up and then they come down. And when the interest rates go up, the prices of real estate come down. And that's a usual thing. But in this market, it was very interesting that they didn't come down as much as everybody thought they would. But that's just a taste of what we can get in later. By the way, this is the first podcast of a series that we will be doing on the Bible of real estate. I will be publishing 2 or 3 books this year. And then after that, I will also be publishing. I write an article every day on LinkedIn and on Facebook about real estate, interest rates, the economy, all sorts of other things, and some great war stories. And I'll give you a war story later before I leave. But the interest in real estate that everybody has is real. And it's something that people should invest in for the long term. One of the things he said was it benefits the community, and that's true. Excuse me. A couple of the things that he said was that you invest in real estate, and he put down that you pay for loan origination fees, insurance payments, mortgage interest, utilities, maintenance. You pay for all of the things that you have to when you rent out property. But what he didn't say, and what is so much more important, is that you get a deduction for something called depreciation. Now, I was a university professor for 6.5 years, and I will give you the textbook definition of depreciation, and that is the systematic allocation of cost of a real or non-monetary asset over benefit. Now, basically what we're saying is if you have an asset that's going to last more than 1 year, instead of taking the whole thing in 1 year, and you can because there are programs for that, but instead of taking the whole thing in 1 year, you're supposed to take it over the period of benefit. And who dictates that period of benefit? And here, for the first time today, you're going to hear of the Internal Revenue Service. The Internal Revenue Service has what's known as the Internal Revenue Code, and everything that's in there is gospel. I was going to use the word Bible, but I'm writing Bible. And for example, a residential building used for residential, like an apartment building, you depreciate over 27.5 years. But a factory, an apartment building, anything used for non-residential purposes gets depreciated over 39 years. And the question is why? Why is always a number that it comes to, and I'm losing a word here, but it's a compromise. And that's all of our laws are compromises because they have to go through the House and the Senate, etc. So the Internal Revenue Code is one of the biggest compromises you can find. And depreciation has unbelievable effects on investing in real estate. I will give you a taste of that now. There is something called bonus depreciation, and there is something called cost segregation services or studies. And what you do is you take a building and you take those parts of the building that can be taken out of the building without destroying the building, and that is called tangible personal property. And you can depreciate that under what was once a law called bonus depreciation. And this year you can depreciate 60% of the cost of that item in 1 year. In 2022, it was 100%. In 2023, it was 80%. But Congress has in it right now a bipartisan piece of legislation that will re-up bonus depreciation to 100% until the end of this year. Well, that's going to change a lot of things, but that's the incentive that real estate investors have, because what does that give you? That gives you a huge amount of cash flow when you buy the building and do your cost segregation study. And that cash flow reduces your income taxes, gives you money to buy the property, gives you the ability to get a loan, because the lenders are going to look and see how much you have and how the loan will be paid back. And bonus depreciation allows you to get, in effect, an interest-free loan from the government. And then I will get into these things as we get further and further into our podcasts. But believe me, there's a lot to know and a lot that can help you. Back to my list. They say that the reasons that you shouldn't buy real estate, and I'm going to take each one that they said and tell you why he's wrong. Number one, he said the high cost of entry. You need to put down a large down payment. And I will tell you that you don't. There is a man, and he is followed by so many on LinkedIn. I forgot his name for the moment, but he does what's known as creative financing. And there are people now who own property who have loans on that property that are at 3%, 3.5%, because they financed the property for 30 years, 10, 15 years ago. And they did it while the interest rates were low. Well, you can assume part of that loan or all of that loan that's remaining at this point under what used to be called an AITD, an all-inclusive deed of trust. And you can keep that 3% loan and then maybe come down with financing or a down payment that comes to that loan, or get another loan to pay the down payment to the seller, or have a second on the property. There are many ways that it can be refinanced or financed, and he's wrong. It doesn't stop you. It doesn't stop a lot of people. He said that unexpected expenses will come, and what you're supposed to do when you buy an apartment building or any other type of commercial real estate is have a fund set aside for repairs and maintenance that you know are going to come up. Because when you buy the building, you do an inspection. You don't do it, you have an inspection company do it, and they come back to you and tell you what's wrong, what's good, and when you may have to replace things. And you can also do these inspections. They're not that expensive from time to time when you own the building. The third thing he said was a high carrying cost. Well, he was concerned that the expenses, the mortgage interest and the mortgage itself, and real estate taxes and everything else were going to eat up your profit. Well, they do come and they are there, but you're supposed to have rents in excess of your expenses. And if you have cash flow from those properties, you're not worried about the cost of running them. You are, don't get me wrong, but you know that you are going to cover those expenses, and you are going to have an excess giving you cash flow for doing what you want to do. And by the way, we have an expression in real estate that you don't work to make money, you make money work for you. And that's a true statement. And you got to know the ways to have that money work for you. And we can do that. We can help you. Maintenance, I talked about. One thing I loved, he said, keeping up with relevant laws. And in California, there are laws that are tenant beneficial as opposed to owner beneficial. And the way to deal with that is to have a really good real estate attorney who keeps up on the laws, and who is creative. When I was a CPA, I was very creative on how I did tax returns and saved my clients income taxes. And I still do that now because I do tax planning. And you want an attorney who knows what the law says, but knows how you should deal with it. And I hate to use the phrase knows how to get around it, but knows how to get around it legally. Like I use the Internal Revenue Code, which I mentioned earlier, to the benefit of my clients and not to the benefit of Uncle Sam. Not a lot of people do that. And the last thing I will talk about before I get to the one that I love, he said it's an illiquid asset. And yes, it's an illiquid asset, except for the fact that you can refinance anytime you want, and you can get what's known as a HELOC, HELOC. My mind just went. It's a line of credit. And that line of credit means you can draw on it whenever you want to, whenever you need to, or else you can go and refinance the property and get what's known as a cash out and put the money in your account and use it when you need to use it. And the last thing that he wrote that I must agree with him, and this hurts, is dealing with the tenants. You can check out your tenants, excuse me. You can check out your tenants as far as their credit history, their payment history, what they make. You can get statements of them of cash flow, of all sorts of things. But you don't get anything that tells you what their personality is like. And different tenants are just going to give you a hard time from day one until the day that they move out. And that's something that you have to deal with. But if you owned a bakery or a restaurant or anything else, you're going to have those things. As a CPA, I was really fortunate because I had clients that I loved. And if I didn't become friends with a client by the second time I did their tax return, I fired them. I fired them because I worked very hard for them and I didn't want to put out that effort for somebody I didn't like. So you have the reasons why you invest in real estate. You have that depreciation, which we are going to go into in great detail once we get past this first podcast, and you will see how it works. And then I told you about bonus depreciation and that it is currently being phased out, but it will probably be extended to 100%. But you've got to understand the cash flow and the rules, of dealing with the income tax laws, because a lot of them deal with real estate, but understand also that so many of our senators and congressmen in the country have real estate investments and they don't want to cut their own throats. And they also know that if they don't give the real estate investor some incentives to invest in real estate, that the building and the buying of buildings is going to slow down, and that's going to hurt the economy. And the party in power in Congress is not going to do that to their president. So that's basically what I wanted to go through. And I'm sure we will have some more with questions from Greg and Betty.
Yeah, thank you, Paul. And yes, there are some people in my community looking at investing in properties, and they already are. And it sounds like you have a lot of insights that can help them. Betty, do you have any questions?
I don't have any questions particularly, but I do have a comment for anyone who's watching this, that keep watching this, because Paul knows so much. He's forgotten more than most people will ever know about commercial real estate. And not only that, but he has a prodigious memory in which he can remember things that he forgot. Working on this book together has been very educational for me. And not only is Paul a wealth of knowledge, but he's a nice guy and he's funny. So stick around and watch this show.
I promised you one of my war stories, and
Okay.
I will give you one of my favorites. After I sold or negotiated the sale of my client to DuPont, such a huge company, I got a phone call several weeks later from head corporate counsel from DuPont. I was in my late 30s. And he goes that my client's wife did something, purchased stock during a certain period of time, which created something known as phantom income. And that my client had to pay $250,000 in income taxes on that phantom income. And I said to the man, okay, let me call you back. So I called my client and I explained the situation. By the way, I told you I fired clients that I didn't get along with after 2 years. This client and I were this tight. And I explained the situation. And my last comment to him was, can I play? And he said yes. And I called the gentleman from DuPont back and I said, I'm not going to pick up the income. Knowing full well, I'm not going to not pick up the income. That was a double negative. I'm not going to not pick up the income because I'm not going to sign a return that's $250,000 short in income tax. But he didn't know that. So he goes, you have to. I said, I don't. He goes, you have to. I said, I'm not. And after he said, you have to a couple of times, I said, do you know what it sounds like when a phone hangs up? And it wasn't a cell phone. It was a real phone that you can hang up and he would hear the clicking going down. And he called me back about 2 or 3 weeks later and he said, you have to pick up the income. And I said, I'm not. And he goes, you have to. And I said, remember how we ended the last discussion? And I hung up on him a second time. Well, a couple of weeks went by and I had my office in an area in Los Angeles called Century City. Everybody had their office in Century City, and I lived in an area called Marina del Rey. And that's where all divorcing guys went to after they left their wives. And it was nice. So I left my office and I ended up going to my favorite watering hole, a place called Bergman's on a street called Fairfax. And I got home at midnight with a buzz on to a message from my client to call him in Wilmington, Delaware, the home of DuPont, no matter what time it was. I knew it was 3 a.m. in Delaware and I called him and he picked up the phone and I said, I woke you. And pardon my French, but I want to give you the real story. He goes, no shit, give me a minute. And he gets off the phone, then he comes back and he goes, they don't like you here. And I said, it's not a popularity contest. And he said, they made us an offer. At that time, the federal income tax rate was 50% and the rate in California was 11%. And you take the California rate and subtract 50% of it because of the deduction that you get on the federal side. Anyway, that came out to 44.5% as the residual. And they took $250,000, divided it by 44.5%, and came up to about $560,000. And they wrote him a check for $560,000, which, after all the taxes were taken out, came out to the penny of $250,000. So they paid the tax. They had nothing to do with the tax. They didn't have to pay the tax. I just knew that DuPont was never going to do anything wrong and was never going to be associated with anything that was done wrong. And I made my client an extra $500,000 or more. And you would think that I could have charged my client a really lot of money, like $10,000, $20,000, $30,000, $50,000 for that. I just saved him $250,000. He paid for dinner when he got back from Delaware, because that was the relationship I had with him. And I have an expression, and I live by it, that the client comes first. Guys, come back.
Yeah. Okay. Thank you very much. I'm just going to put out an invitation here. We have an early version of the Bible of Real Estate in a digital edition, which also is going to contain the recording of this and the video of this, and also the other future episodes of the Paul Levine Show, and more war stories. So, and also
I have a lot of them.
when you sign up, you'll end up on a mailing list, and we'll send you a notice to either come join the show live or watch the replay. So, and it's all free. The price is right. Come on down.
Yeah.
That's one of my war stories because I was on that show twice.
Yes, that's for sure. We're going to track that down. We're trying to maybe put the episode that you were on, the 2 episodes, and put that in there.
That would be funny. That would be neat.
There we go. Because you got the price right. I heard you tell the story, but leave that to another day.
The bottom line, and if you know the show, you know that you have to bid on certain items. And my showcase was a pair of roller skates, an exercycle, which I used and lost 60 pounds, and a piston engine Mazda. And in those days, remember, this was 1972. I figured the car was worth maybe $2,500, and that the roller skates and exercycle put me over, and I had to be under the retail value. So I bid $2,500. The actual retail value was $2,504. I was off by $4 on the very first show. And there are people that watch that show every day and write down the prices of things because they try and get on and try and be lucky that those things will be on and they know the prices. I know nothing. I came with $4.
That takes you back to what we were talking about right before the show. Like grandmother's coffee cup. All the planning in the world will never replace dumb luck.
You betcha. That was just, off the top of my head. But I've been lucky all my life. I really have. I've been in situations in my accounting practice and in real estate where opportunities were just there, and it said, do you want to take this opportunity? And I never said no, because I am a nice Jewish boy who grew up in Brooklyn, and you don't say no to opportunities, and you fight to be the best. And I may be self-promoting at times, but when you have a group of friends, we're all trying to be, as the game was called, king of the hill. We all wanted to be on top. And the way the game is played is everybody tried to knock that guy down. And so when you did something good, you let your friends know it. And also, if you didn't do good in something, and we were all very concerned about scholastics, then if you didn't do well, they would get on you, but they would get on you with love. And we all wanted everyone in the group to really do well. And we all did. I mean, it was a great way to grow up. It was like going to camp every time I went outside, because there were about 30, 35 buildings with 84 apartments in them and kids galore.
Nice.
Oh, that's fabulous. I think one of your superpowers, Paul, is that you can make real estate and tax fun.
When you come up with things that nobody else did and you look at it realistically, it is fun. It's a game to me. And that's why I do well, because I hate to lose the game.
Hate to lose the game.
You laugh. I mean, I was lousy.
Because I know how true it is.
I'm lousy in sports. I couldn't play sports. I wasn't fast running. I was always the last one picked for the softball game. But I'm doing really well now. So I worked hard to get where I am, but I worked hard improving myself.
Yeah.
Mm-hmm.
So that's great. So everybody come back next Thursday at noon Pacific, and we'll be back here for the next version, the next episode of the Paul Levine Show. And be sure to go visit the Bible of Real Estate.info and sign up so you can get notices and more fun stuff.
Yeah,
More fun war stories.
I promise you will learn.
Yes, I was a university professor for 6.5 years. When you take the layers off of me, there is a teacher standing there.
A teacher, yeah.
Yep.
Okay, well, I think we'll carry on with our day and let everybody go. And happy Thursday, everyone.
And thank you for watching.
Thank you for watching.
Right.